That's what I was going to say. All right, so welcome to the last instructive class. I am going to do videos for the office hour sessions next week and on the finals day, which is 2 weeks from today at noon, because people might want to see what questions are being asked or go over some problems. See the problems I go over with everybody, and since I post them online to the online class as well, if they might have interest in that as well. What I was going to remind is that in case it's not just as a reminder, I think it is clear, but it's been a while perhaps since you've looked at the schedule. These next 2 weeks are kind of a little weird, or unusual. The pattern is we have a new topic and we have a quiz for that topic that week. That's true if we merge these 2 weeks. So this is like the final exam review / final exam 2 weeks. And there's nothing other than the final exam review quiz and the final exam itself that do these 2 weeks. I'm kind of expecting them both to be done concurrently. There, this 2 week period starting. I say this week. This next week that starts on Monday the 24th. So what I'm trying to say is that don't next Friday freak out and think the exam review quiz is due, because you're trained to say, well, Friday's coming, that means the thing for this week is due. That's not true. The exam review quiz is not due till the end of the course, the same time that the exam review quiz is due, which is, just to make sure, double checking here, it's the Friday of that last exam, final exam week, due May 5th, the end of the day, Friday. So that's finals week here, the end of that Friday right there. That's when both of them are due. So yeah, don't fret the end of next week and say, well, I can't do the final exam review quiz anymore. I'm going to leave it open so that if you want to use it to get extra reps between your first and second attempt, you have it available, and you can prepare that way. Okay. So let's look at 10-2 here and go through at least a decent assortment of the problems that are due tomorrow. All right, so this one here is simply asking us to figure out the residual income of this investment center. So residual income is defined as profit minus the profit necessary to break even from the cost of capital, which is I got rid of the parentheses, investment times, not 8, times the cost of capital, or required rate of return, or hurdle rate. I think I use a few different terms here, but they all mean the same thing in the context of this chapter. I have no other context in which I would give you no other meaning for it in these questions. So we can pretty simply do this once I get numlock off. 188.1 is profit, 0.075 is 7.5% cost of capital, and 1643.1, all in millions of dollars, is investment. So profit minus cost of capital times investment should give us our residual income right there. This seems very familiar. These numbers, we did this very problem. Okay, well, and I once I looked at the answers, I'm like, oh yeah, well we can rule out 2 of these because they're percentages. Huh? So here we're simply saying we earn this number of profits. Not some of that is already kind of spoken for by the debt or equity or retained earnings that we invested into the assets for this to earn that profit. So we spent over $1 billion here to create some new region, some new product line, some new sub company or whatever as a big investment, and it's earned this number of profits. But some of that's already spoken for because that's not free. It costs something to come up with that $1.6 billion in debt or whatever. And so we have to earn back 7.5% of that. That's the cost of capital. So we need to subtract away that 7.5% of the assets that it cost us from the profits. And what's residual, what's left over, is like what we really did earn above and beyond what we needed to earn just to pay back the investment itself. That's where the residual part of it comes in. Does that answer the question? Okay. Oh, good. All right. Let's try to be quicker about this one right here. Which one is true about residual income? Residual income and return on investment both yield percentages? Nope, they don't. Residual income is a dollar amount. Residual income is a dollar amount. Return on investment is a percentage. Okay. Residual income is an important type of transfer price. No, same quiz, but that's not a true statement. It just happened to be together on the same quiz 10-2 doesn't mean anything. That's untrue. Residual income measures give investment center managers incentive to invest in all projects that promise returns greater than the firm's cost of capital. Yes, they do. If my bonus is somehow tied to residual income, then every investment that has more profit than is required by the investment amount at cost of capital is going to have a positive residual income, and so I will be incentivized to accept that project. So this is the right answer here. Residual income is often used to ensure profit center managers do not reject otherwise profitable projects. Ooh, so close. There's one word that's wrong there. The first or the only time profit by itself is used. It's not profit center managers. Profit center managers don't get evaluated based on residual income. They don't get a bonus based on residual income because they don't make investment center decisions. They didn't decide to invest in this new region or new product line. They decided how to execute that product line. They're a profit center manager. They control costs and revenues. So they're going to be evaluated based on the profits from their profit center. Once all the service department costs have been allocated and the full cost of their activities has been considered. So this word right here makes this an incorrect statement. It would be true if it said if it said investment center managers. I was ready to go, and then I read the word, and I saw the word, and I wanted to read it. If it said investment center managers do not reject otherwise profitable projects. Okay. Here's an ROI and residual income together problem. So we're going to have to figure out the residual income and ROI of both of these because the answer choices are asking us if they both agree or disagree. Do they say to accept or reject these different projects? So let's write down a few things about Egress LLC here. Oh, please. We know that the cost discount rate or hurdle cost or cost of capital is 15%. We know that the manager's current ROI, because of the success of the prior investments from this manager, is 21%, or the investments that are in this investment center manager's decision rights. All right, I have a parenthetical here, and when I don't have this parenthetical, for the purposes of what we're doing in Chapter 10, you can go ahead and assume it. If that bothers you, I'm not talking about mutually exclusive projects, and so we're just talking about the incentive difference of these two measures. If that doesn't really make a difference to you, then don't worry about it. So we have project 1. And 850,000 is the investment, or the assets invested. 187,000 is profit. Project 2 has 205,000 as the investment, and 51,250 as the profit. So we can simply take profit over investment to get ROI. Copying that over. Profit over investment for ROI. Both these ROIs are above the cost of capital and the manager's current ROI. So does either of these projects fall into the donut hole where the manager will be like, nah, I don't want it? No. Both the manager and the firm would say yes to both these projects. Just everything else ignored or all things equal. So we can rule out anything ROI suggests manager should only accept project 1. No, that can't be true because ROI says to accept both. ROI suggests manager should only accept project. No, that's not true. ROI definitely suggests manager. Oh, that's wrong too. Well, we've figured out what the right answer is just by ROI calculation there. Profit minus investment times cost of capital gives us the residual income, just using this equation that's right up here. And both of them have a positive residual income. So just as a short soapbox, let's see if I can say it in 30 seconds here. This really illustrates what I was talking about when I said comparability is the strength of ROI. If you look at project 2, the residual income looks tiny, 6,150, compared to project 1, which has 59,500. Project 1 is just such a larger project. It's enormous. It's almost $1 million of investment. Project 2 is much smaller to start with. When you look at the ROI of the two projects, we really are getting more cents on the dollar back from project 2. It's just smaller. So ROI allows us to compare them more easily than residual income, which is scaled by the size of the project. I'll leave that said that way. That's fine. Okay, which of the following shortcoming residual income can it easily be combined with other performance? We did this one already. No, that's not true. That's how we've introduced it. We've talked about the entire time. It's combined with ROI when it's used. Residual income leads managers to reject projects the firm would rather they accept. No, that's the purpose of it, is to help incentivize managers not to reject projects that the firm would prefer they accept. Residual income does not take into account the firm's cost of capital. No, it's right in the equation, right there. And so higher residual income might only indicate a larger but not a better performing department. So if these two were like two different departments or two different regions, you look at residual income by itself, you're like, wow, project 2, region 2, department 2, product line 2, whatever you are, you're underperforming compared to project 1. Well, not really. Project 1 is just that much bigger. Oh, hold on. Okay, everything still stands that I said. Project 2 still is smaller, just not quite as small as I was saying before, because I didn't make the cost of capital cell absolute. It was multiplying instead of by 15% for the cost of capital. It was multiplying by this 22%. It just happened to fall on another decimal that made it seem like a reasonable number. Yeah, there we go. Okay, so still, Project 2 looks smaller, just not as small as the bad Excel work I did before made it look like. Okay, questions 1 through 4? Oh, okay. All right, question 5. I think I'll just go through the whole quiz here. Yeah, more than halfway through, or about halfway through. Production department A uses hydraulic valves as an input and can buy these valves at an external market price of $800 per unit. Oh, Question stem says maximum transfer price, the ceiling. Who sets the ceiling, buyer or seller? The buyer does. The buyer sets the ceiling. It says no, it's too rich for my taste. I'm just going on the external market. So the buying department can buy it on the external market for $800. If we're negotiating transfer price, that's going to be the ceiling, right there. We can stop there. One of the strengths of reading the question stem early on, if not the first thing, you can ignore all that blather. Question 6. A production department can purchase a particular valve from vendors outside the company at a market price of $1,000 per unit. Whoa, 2 in a row. Again, we've got a maximum negotiated transfer price, the ceiling, the buying department, purchasing department if you want, can buy it on this, whatever the input is valve. The other one, a valve too. Wow, why am I doing so many valves? It's weird. $1,000 in the external market. So that's going to be our ceiling. Cool. Okay, now we've got a floor one. And we did this one, or something very similar. I can compare right now, because a lot of them are set up similarly. We have excess capacity to produce 5,000 units. The buying department needs 4,500. That's under the 5,000 excess capacity. We have plenty of capacity. So there's no fixed cost for selling internally. So the F in P equals F over Q plus VI. The F is going to be equal to 0. That means the floor price equals just VI. So what's the answer then? I heard 26 and 21. It's in 21, yeah. This we only care about the variable selling and distribution costs on external sales insofar as it helps us figure out the unit contribution margin, which helps us calculate the F in terms of how much lost contribution margin we have from those lost external sales. Okay. But questions on that one? We've had 3 questions in a row. We didn't have any calculations. Going too easy on you. Oh, okay. Yeah. Yeah, this question uses that terminology too, right? The one we're looking at right now. So a firm is considering multiple projects, and the firm's required rate of return, or what are the terms I use up here? No. Discount rate, hurdle rate, cost of capital. Insofar as this class and this chapter is concerned, we're going to use all those terms interchangeably. Cost of capital, hurdle rate, discount rate. I don't think I've said that before. And required rate of return. Point is, it costs us some money to come up with these investments, and we need to pay that back before we even broken even on these long-term investments. So we can use whatever term we need to describe that. All right, 13% is our required rate of return. All right, what are we doing? The firm picks the project with the higher residual income. What is the residual income of that project? Okay, so I'm going to have to calculate the residual income of these 2 projects and type the higher one into here. Okay, that's a sneaky way of requiring you to do multiple calculations. Who would do such a thing? Okay, here's project 1, or A, P, A. That's the investment. Also add, that's our cost of capital, or required rate of return. And 116,947 is our profit. Project B, we have 1915638, 494061. Same labels. And residual income is profit minus investment times rate of return, or cost of capital. Okay? So that's our residual income. And I'm going to learn my lesson here. I'll make that absolute reference because I'm going to copy this over right here. Ooh, looks like project A actually has a negative residual income. Yep, that looks right. Which makes sense because the rate of the ROI is going to be like 11%. I could tell 116,000 over 1,044,000, 1,044,044. Looked like it was less than 13% right here. So if the ROI is less than the cost of capital, that means it's going to have a negative residual income. Okay, but project B has the higher of the two, which means it should be the one we put in. Okay, any cells you want to see? All right. Good old-fashioned open answer transfer price question. Okay, we're negotiating transfer prices. We got a seller department and buyer department. Buyer has a ceiling of 110 because that's what they can get this good for on the external market. Selling department has the following input costs, cost for the input. We're only going to be worried about the variable production costs, which are these three right here. All right, so we have 21 DM, 25 DL, 23 variable overhead. So this is the variable manufacturing costs, which also is V sub I. How can I get you to do a subscript? It's not worth it. All right, we got one of our numbers. Looks like our capacity overall for selling department is 1,000 units per period. Currently, we sell on the external market 500 units. That's how much demand they have at $97 per unit. So let me write that one down too. 97 is seller external market price. And 1,000 is capacity. 500 is our external market demand, which means the difference between those two is our excess capacity. So far, so good? See some nods? All right. Scroll up a little bit. Okay, so we can only make 500 units of the 700 they're requiring, which is going to be our Q. All right, so that means we have 200 lost unit sales. Is that okay what I did there? I took the 500 excess capacity, subtracted it away from the 700 quantity demanded internally, and said, well, that means that we've got to kick out 200 of these external market sales, 200 units worth of those external market sales in order to fill that demand. So we're gonna pay that back, the fact that we have to do that, in our floor price. Okay, there's no indication of any external variable costs, variable selling costs like this one. So that makes it a little easier. So let's figure out unit contribution margin. Because each of these 200 units of lost sales is going to come with a contribution margin. We sell it for $97, costs us $69 to produce. That means each unit, and variable cost, that is, costs us $69 in variable cost. That means each unit comes with a $28 unit contribution margin. So $28 times 200 units, that gives us total lost contribution margin of $5,600. That's the fixed cost. And now we can just take these numbers and plug them into the equation. So I've identified Q, That's for this part of the equation, I've identified VI. For this part of the equation, no, plus is right. I wrote the equation wrong. Now I'm all. Start over. F over Q plus VI. There we go. Okay, so that should match the equation here. The F, 5,600, that's the fixed cost of selling internally here, divided by the number of units we have to sell internally, plus what it literally costs us to sell each unit internally in terms of variable costs, gives us a floor price of $77. So negotiations are going to take place for a transfer price somewhere between $110 and $77 is where that transfer price will land. Okay? Good question. No, it's even. That 5,600 happened to go into 200. Okay. Okay. Good point. All right. So, any 10-2 things you want to send me hunting down? Questions you have? Yeah. Sure. False about. Okay. Didn't find it there. Let's keep going. It does that little strum about 3 or 4 times usually, and then it gives up and says, I can't reach you. Yeah, there it is. It stopped making the sound. I don't know why. That's a mystery to me. It just gives up on me. This one right here? Okay. So which of the following is false about transfer prices? So A, a transfer price based on negotiations between department managers is always best. Do we think that's true or false? You can go out on a limb. You think false? One person responded. I think it's false too. Here we go. I think it's false too. We can check the others, be sure. We have spent a lot of time on negotiated transfer prices, but there are different ways of figuring transfer price. Different ways of figuring transfer prices for a reason. There are different reasons why you would use different ones. There's no best answer. In fact, it says in the textbook very clearly. It's like none of these is best. Okay, so that's definitely the right answer. But let's just double check. Minimum price to be negotiated between two departments should cover the variable costs and opportunity costs of the selling department. And that's what this equation does. Cover the variable costs and the opportunity cost, which is the fixed cost of taking it over the number of units that are demanded. Okay, there is no universal best method. Fix that typo. So this is saying the opposite of what A says. This says, oh, well, negotiated transfer prices are always the best. There's a big tell, too, if I'm saying always. Unless it's something I drilled in and it's always it's some sort of unbreakable rule. You have these kinds of absolutes. You can point to it and say, no, you're probably wrong. Sorry, no universal best method for setting transfer prices because all methods of setting transfer prices have trade-offs. That's a true statement, or that's in line with what we taught in the textbook here. And the maximum price to be negotiated between two departments should reflect the price the buying firm can purchase the service or product from an outside supplier. Yeah, the external market price for the buying firm is the ceiling. That's true too. So yeah, these three are true statements, which makes this one false. Good. Okay, let me fix that. One more note I need to make. Okay. Yeah. For Forever 2.1. What's the maximum? Oh, okay. Well, we know that the maximum is the ceiling, and that's set by the buying department. So they're not going to pay more for this transfer price internally than what they can buy it on the external market. So whatever the problem pretty early on should say what the buyer's external market price is. That's going to be the maximum. Does it say the selling department can do that? The sewing. Oh, sewing, I misheard you. Yeah. Yes, that should be it right there. No problem. Okay. Yeah, I thought it'd be real clever there. Forever 2.1, like 2.1 years old, toddler. I like that one. All right, well, I think we'll move on from 10-2. As always, you can ask me after class here, or email me if you have questions or give any problems before Friday. So let's go over a good potpourri of questions here from the final exam review quiz. All right. You may have picked up as we went through the questions, just looking through the questions at the end of class Tuesday, there's decent coverage of Chapter 6 on this. That's because we spent 4 weeks of the course on Chapter 6. So almost entire, the guiding light of the coverage here is how long we spend on each of these. Generally speaking, that's how I try to arrange it. If we spend more time on a topic, it has more questions. It should map pretty closely to that. And the final exam review quiz's coverage of each chapter should be exactly the same as the final exam itself, its coverage of each chapter. Okay, so should we try this question? Review some chapter 2 stuff? Okay, excuse me, yes? All right. So here is firm, unconventional disruption. We have a new line of close, apostasy. We're considering adding. Okay, so just like keep or drop, except we're not deciding whether to have the status quo of current set of lines and dropping one. We have the current set of lines that we have. That's the status quo, and then we're saying should we add one? But the calculation is very similar. We have one setup where we have more product lines and one setup where we have fewer product lines. So we're simply comparing those two alternatives. The new line's revenue, or this apostasy line, would be $700,000, but its cost would be $800,000. So it looks like a loser right there. Well, I can do math. That's a $100,000 loss. After some study, though, for some reason, we still wanted to study this thing, the firm finds that $35,000 of the $800,000 in cost can be avoided by using machinery the firm already owns. Okay, so it's not $800,000 cost we were lied to by the professor. It's $35,000 less than that. All right, let's start putting some stuff into play here. So this is unconventional disruption question. So we have don't add, which is the status quo. And then we have add. So the add would give us the apostasy line, which has $7,000 of revenue. And it costs $800,000 minus the $35,000 right here. Okay, so that's our cost right now. We've incorporated all the information so far. We have two other related clothing lines. All right, so we can put these in. We have the fulfillment line and the emptiness line. All right, I think I made all the jokes associated with these silly names when we went over this at the beginning of the course, so I won't bore you with any sort of jokes about that. All right, so they earn us $2.5 million and $1.35 million in revenue. I'm going to copy that over here. We probably will change this a little bit with later details here. But those are our revenue for these two right here. And we don't have any information about the cost of these two. We're going to assume that they stay constant between the two options. We have no reason to believe they don't, at the very least. Okay, so given the fact pattern that we have here, I'll make it make a little more sense. Okay, so yeah, here's the status quo, the two that we have, and I'll incorporate this paragraph in just a second, and their cost, which we don't know, but let's assume they stayed the same across alternatives. And then we have this line in the add section, which we don't have over here, which has costs here and revenues here. Now, if we add the apostasy lines over here in this alternative, alternative, revenue for fulfillment, this line, would decrease by 15%. So this equals 2.5 million times 0.85. All right, but emptiness would increase by 30%. No, increase 1.3 per. Yeah, 1.3, not 0.3. Okay, so let's figure out the profits here as far as we know them. Sum of the R function or revenue function minus the only cost number we know, which is apostasy, which is nothing there. So we can compare them. I just copied it over. If you really wanted to, you could make up numbers. And then sum those in, but I don't need to. All right, so is it more profitable to add or not to add? So someone shaking head. More profitable not to add. Actually, it might have been in reference to that question. Yes. This number here, maybe it's hard to see, is bigger. That's a higher profit than this number over here by about $35,000. Add minus don't add. Yeah, add earns us $35,000 more dollars. So, yep, they should not add the new line because they are $35,000 less profitable if they add it. Here we go. Okay. It takes us back. I know, this was back in January we went over this. Like we were different people back then. We've been through so much this semester. Okay. No raised hand. Okay. Let's try this one. Now, you might think, he told us these chapters were in order, and here we're talking about a floor price. That's a chapter 3 question. We also have the special order floor price chapter 3 questions, remember? All right, so firm sells a product for $100, variable cost of $45, so the contribution margin is $55. That's the difference between the price and the variable cost. And a customer approaches the firm with a request for a special order of 1,000 units. The customer wants a discount because of the size of the order. They're special customers, so it's a special order. There are no special fixed cost purchases required to complete the order, but we have limited capacity. We only have excess capacity to produce 500 units of the special order. So out of the 1,000 units, we can only produce 500 without kicking out regular paying customers. So it looks like the other 500 will have to Well, that'll be our lost unit sales. Now call price. And P equals F over Q plus V. This was in simpler times when we just had V. There's no VI or VE because all special orders are external back in chapter 3. Because we got V, variable cost per unit, right here. And I told you the unit CM because I subtracted them in my head. And we know that we're going to have 500 units of lost sales to accept the order. Okay, I got that. I said that verbally. They want 1,000 units. We have excess capacity for 500 of those units. That means the other 500, or 1,000 minus 500 equals 500, is our lost unit sales down here. Which means this is our total lost CM. I said total, but I didn't type it. Total lost CM is 27.5, which is also our fixed cost of taking this, since there are no other special fixed costs we have to add. Remember back in chapter 3, so don't let chapter 10 supplant your chapter 3 knowledge. In chapter 10, there are like never any special fixed cost purchases you have to make because you're in the same company. You have all the licenses you need to serve each other. Very unlikely that you don't. Whereas here, special orders can come in and they'd be like, well, yeah, but we want a Mickey Mouse sticker on it. I got to pay Disney a boo-goo bucks for that. So that's a fixed cost of taking that special order. Yeah. Yep. So if it were $1,000 here, then it would be the fixed cost from opportunity cost plus the $1,000 fixed cost, and this would be F. Does that make sense? No problem. So I'm going to undo that in a second. Yeah. So the opportunity cost here is the 500 units of lost sales times the contribution margin from each of those sales. So I'm calling it opportunity cost because it's by accepting special order, it comes with the cost of not being able to serve regular paying customers. So lost contribution margin from those customers is the cost of taking the special order. Okay. I'm going to get rid of what we just did, since for this question, we can just go with F. Actually, you know what? I will keep the labeling to make it easier. So F, there we go, is our opportunity cost, which is the total loss contribution margin due to limited capacity, plus any extra fixed costs. None for just this problem. So F is the sum of those two. Okay. All right, so let's take that. F. Oh, wait. I did too many things in my head. I never wrote out that Q was this. So this is, I didn't do it in my head. I did it verbally with you here. So this is our, that's where that comes from. So now it's all linked. All right, so now we can take the F divided by the Q and add the variable costs. Just following the equation here. F over Q plus V. Just labeled everything. I'll even make the labeling more clear. That's V. All right, so that should be our floor. Is that okay? All right. Yep. Yeah, the transfer prices are never going to have this be, at least in this textbook anyway, our test bank. This will always be 0 for transfer prices in chapter 10. Mm-hmm. Yep. Yeah. Yes, that's also the case. We don't have to worry about VI, VE difference. It's just there's just one one type of variable cost in special order decisions. So this right here, $45, incorporates any external, any VE. It's if there is a cost of a variable cost for external sales, it's in that $45. When it's a transfer price, it's a question of selling internally, where you don't have to get fancy boxes and packaging and everything, versus externally, where you do have to get the fancy boxes and packaging and shipping. Then the difference in variable cost makes a difference. So that's why we do it in Chapter 10 with VI and VE, if that makes sense. Yeah. Okay. Yes, some of them do say there's a special $5,000 machine you have to buy to make this special mold that they want. And so that's a fixed cost of accepting a special order. So yeah, that would go this cell right here based on how we build it. Yeah. Can I show you this? Yeah. I can come over there. No, that's fine. I'll come up. That one right there? Okay, let me copy down the numbers up here. We'll go through it here. It's a nice short text. We can do that. We can do that kind of semi-remotely here. So margin of safety. I don't think we'll get a margin of safety. It's unlikely. Yeah, so let's go to review. Margin of safety here. I know fixed costs said were $12,000. So it says that we sell units at $50. It costs us $26. And we have $12,000 of fixed costs. And we earn $900,000 of revenue. What is the margin of safety since we earn $900,000 of revenue? It's basically the idea. The margin of safety? Oh, 90,000. Okay. Well, two questions. First, is it asking for margin of safety in like dollars? In dollars. Okay. It won't be quite that simple. It looks like it's tempting. We need to figure out our break-even point. So let's do that right here. Then we need to figure out from the break-even point how much that 90,000 is above that break-even point. So the break-even point in terms of dollars is not the $12,000 fixed cost. It's how much revenue we have to earn to cover that $12,000 of fixed cost. Because for each dollar of revenue we earn, some of that's already spoken for. 26 out of 50 is already spoken for. So we need to take 12,000 here, divided by the unit contribution margin to get our break-even point in units here. Which means that the break-even point in dollars, revenue dollars or sales dollars, is that 500 break-even units times the $50 per unit. So at $25,000 of sales, that's our break-even point. So now we can take the difference and make it real easy. Just take the difference between that 90,000, and that is our margin of safety there in dollars. Yeah. Does that work and make sense? Yeah, thanks. Okay, yeah, no problem. Okay. All right, we did. Well, let's look at this one. This is the CVP Advanced one because it has multiple products, and we'll do it as quickly as we can. CVP Sun 2 question. So we have $5,000 $18,000, 10,000. I'm transposing the table here. 4,000, 5,000, and 5,000 for our three products. SWSCH. Okay, we can do the unit contribution margin for each of these by subtracting, not multiplying. So for each unit of these three products, we earn this much. But we don't sell them just unit per unit. Problem is we sell them in a mix. These three have a certain mixture that they tend to have. 1, 3, 2. So we can multiply to get a bundle. We're creating bundles. If that, maybe some bells are ringing if you've forgotten this. We're going to create a bundle of units where we have one Sunwoo, one Sunsi, and one Chongqing in there. That bundle. One Sunwoo, 3 Sunsis. I said one every time. What am I doing? 3 Sunsis and 2 Chongqings in there. And we sum that. What is this contribution margin for that bundle right there? It's $50,000. So we can take that bundles. I think that's 5 million. Yeah, good. Fixed costs. And we can say each bundle earns us, this is the composite units, CM or bundle CM. Each bundle earns $50,000. So how many bundles do we need to cover the $5 million in fixed costs? We need to sell 100 bundles or 100 composite units at break even. Okay, and you're going to be tempted. Oh, tempting, very tempting, but that's not right. How many of these Chongqings are there in each bundle? 2. So it's going to be twice this. No. At break even. That's what I'm trying to say. This is how many are per bundle. So we need 200 at break even. Okay? So it's been a while. I want to go over that because the old things that you've learned back in January, February, to not fall into temptation, you might forget not to fall into temptation now. Okay, here it is. Remember, don't stop here. You got to make sure you're answering the question that's being asked. It's asking how many of this particular product must we sell at break even. Okay, nice easy activity rate question. We have the cost per cost pool. We have only these product D and F as our potential consumers of these products, and so they're going to be the denominator here. So activity rate question. It's asking specifically about the activity rate per setup. So whatever cost pool this is named, it has number of setups as the activity driver. That's what it says at the top. That's what that means. Activity drivers at the top of the columns. Number of setups. So activity rate per setup is going to be based on $11,000 in that cost pool divided by the total number of setups we're expecting, which is 20. Right? Nice and easy. Okay. All right, let's remember way back. Oh, we got an open answer one too. To time-driven activity-based costing. This is the advanced ABC section, the quiz. So the idea here is we are going to figure out a capacity cost rate by taking what is overhead, what we're going to call overhead, in the numerator and divide it by whatever the constraint is. In this case, we're talking about nursing hours, 2,982. And I've labeled each of these 4 as overhead costs. Some of the questions have you discern whether or not it's an overhead cost. Some of the bullet point numbers do. Some of the bullet point categories are traced to individual patients, and so they are not overhead costs. They're direct costs because they're directly traced, whereas the other ones are not directly traced, so you have to consider those overhead. Here, that's not the case. They're all overhead costs, so we're just going to add them all together. Let's see if I can get away. I can't without. That's probably just as fast to do it this way, I think. It's not going to like the spaces. Can you sum? Okay, good. It does consider the numbers. All right, good. So the sum of these overhead costs is 94,293. We have 2982 as our, it's not a dollar amount. Constrained hours. Usually it's hours we're talking about. So we can get a capacity cost rate by dividing. All right, maybe that seems like ancient history. Probably in February we went over that. That's step 1 of 3 steps of time-driven activity-based costing. Develop a CCR. So now we know per hour, per nursing hour, our overhead really charges us $31. And so then we're going to say, well, how many nursing hours does each of these activities take? And charge them $31 per nursing hour that they take. $31.62. Yep. On up here? Yeah. Let me type this in first. 31.62. Okay, what's up? I took the total cost pool amount right here. Yeah, for setups. So this is asking for the activity rate per setup here. And I divided it by the total number of setups. Most questions make it clearer the total denominator here. And they say, here's the total number of this or that. Here I'm trying to be clever and have you infer it. If I'm not mistaken, I actually got this question from a different person, so I'll blame that person. Yeah, I'll go with that. But yeah, that's basically the idea. We only manufacture the 2 products, D and F. For some reason, we started there in the alphabet. I don't know why, but those are only 2 products, and so then we only expect 10 or 20 setups total. Is that all right? Okay, good. Yeah. All right, let's try one more question. Squeeze that in here. Okay, good. We get to stop before chapter 6 stuff, because we all have blocked that out of our memories, right? We don't talk of that. So this is a first stage allocation question for ABC. Got Wise Guys PC, and we have general ledger overhead amounts of here, $1 million and $600,000 in these 2 expense categories. Expense accounts, or budgeted to have that amount in those expense accounts. And we're going to try to get those 2 into 3 activities: deconstructing activity, the disintegrating activity, and the other activity, which will be a period cost. Let's remember that. And then we have here the total budgeted activity drivers. So like I said, it's clearer what the total amount for these 2 the activity cost pools are, with total denominator. So we can develop rates from that. We can take these numbers times these percentages and sum the columns, divide the sum by their respective denominators, the total activity driver. And then we are asking about a specific job, which has $200 direct cost. Don't forget to add that. And 5 units of whatever the activity driver is for the deconstructing activity, and 10 units for whatever the activity driver is for the disintegrating activity. And so we can then figure out the job cost. All right, I'm copying over those right there. Let's see if I can copy over this stuff. Yeah. Put that in order there. And so I'm going to copy this table again. And I'm going to reprogram in these. I'm going to clear these. See if I can through the percentage formatting. I'm going to multiply the amount in the general ledger category here times the percent for this columnar activity. I want this to be absolute in its column. So when I copy it over to the right, it stays. And it didn't get rid of the percents. These are dollar runs. Okay, so 25% of the million is 250,000. Again, 25%, 250,000. And 50% is 500,000. 50% of the 600,000 is 300,000. And same with this 50% right here. Great. Now we can sum. So it looks like each cost category, just because I made the percentages all matchy-matchy, each of these cost pools, is what the term is for it, have $550,000 in them. Okay. Oh, I got it in caps lock somehow. Okay, we can divide them by the total activity driver to get an activity rate. Excuse me. There is no activity driver for the other category. It's a period cost. So $55 per unit of the deconstructing activity driver, $34 per unit of the disintegrating activity driver. And the Sabio job has $200 of direct cost. It consumes 5 units of deconstructing and 10 units of disintegrating, which converts into $55 times 5. This is overhead from deconstructing. And 10 times 34, overhead from disintegration. Sum these. Direct costs plus our overhead. That should be the right answer. Total Sabio job. 819. Looks like we rounded somewhere. Yeah, 818.75. Good. This was sorry, it had stage 1 allocation in it, first stage allocation, but it was a full comprehensive problem. All right, so thank you very much.